Should you be using your extra money to pay down your mortgage? Or should you be using this cash to invest? Or should you be doing both? It's a common question that many people have. We'll take a closer look at the pros and cons of each approach and things you need to consider for your strategy. The biggest element to consider when deciding whether to pay extra on your mortgage or use additional money to invest is the interest rates on offer and what you can get for your home loan. The Reserve Bank of Australia has cut the official cash rate to record lows in recent times, and many predict it will stay this way over the next few years. But who really knows? Banks and financial institutions are offering extremely low home loan rates at the moment, particularly for fixed loans, with some under 2%. By paying extra money off your home loan, this means the immediate return on your money is at this low interest rate. Say you had a home loan currently financed at 3%. In simple terms, you would need to find an investment that would return at least this amount annually to come out ahead with your money. This is the basic comparison you need to consider in deciding whether to pay extra on your mortgage or to divert extra funds into investing. Can you outperform your own home loan rate with your investment strategy? Of course, it's not exactly this simple, and there are other factors to think about. A big appeal for many in paying extra on your mortgage is the psychological and emotional attraction of owning your own home outright. Home ownership has been labelled the Australian dream for a long time for the security and opportunity it can provide for families. Paying down your mortgage is an instant and guaranteed return, and completely risk-free. There's also no additional tax to be paid as long as it's your primary place of residence and not considered an investment property. The current low interest rate environment allows homeowners to pay down the principal of your home loan aggressively, potentially cutting years off the total term. Just an extra $200 a fortnight on a $300,000 loan at our example interest rate of 3% can cut a decade off your home loan term and an interest saving of over $50,000 over the life of the loan. Paying extra off your mortgage also protects you against any future interest rate rises. And even a rate of 7.25% in 2008 would be enough to stretch family budgets depending on their circumstances. You only have to look back to 1990 where the RBA cash rate was at 17%. Let's turn our attention to things to consider when using any extra money to invest. A basic, long-term index investing strategy in the share market could comfortably surpass the 3% annual return you would receive by paying down your mortgage in the previous example. Conservative estimates would put this figure closer to 7% annually, depending on exactly how and where you're investing your money. So on paper, you have a much greater potential to maximize your financial growth by investing, instead of just paying extra to your home loan. Let's take a simple example. These two people both have a $300,000 home loan at an interest rate of 3% for a 30-year term. Minimum repayments are $1,265 a month, and person one will pay an additional $500 a month on top to pay down their mortgage faster. Person two instead sticks to the minimum monthly repayments and uses that extra $500 a month to invest in an index tracking ETF on the share market. We'll use the 7% return on this investment we mentioned previously, which is still a very conservative number. Person one pays $1,765 a month and will have their home loan paid in full in 18 years and 6 months, saving almost $65,000 in interest. They then put the full $1,765 each month into the same ETF as person two for the remaining 11 years and 6 months for a 7% return. This nets them a final balance of $349,452 plus a fully paid off home loan after 30 years. Person two instead invests that extra $500 for the full 30-year term of their home loan at a 7% return, which compounds to a grand total of $609,985 once the home loan is fully paid off. You can see for yourself that person two has almost doubled their net worth compared to person one, who decided to pay off their mortgage early, despite paying more than $60,000 of additional home loan interest. This is an eye-opening comparison, but as we said before, it's not quite this simple. Investing comes with risk and is a long-term play. Performance can vary week to week, month to month, and year to year. If you do choose this path, you will need to tag out the emotion and commit to a long-term time frame to reap the benefits. Home loan rates can obviously change as well. This can alter the results completely if rates climb and the figures become skewed towards paying down your home loan instead. In the end, both approaches are fantastic for financial security and have their own advantages and disadvantages. As always, a lot of it depends on your own personal circumstances, like your job, financial strategy, and appetite for risk. As we always say, it's about what works for you and your family. Hopefully this video has at least opened your mind to the opportunities available in the current economic environment so you can really consider how you want to approach your financial strategy. Until next time.